morning, everyone. I'm Shira Zimmerman, Investor Relations Lead for the Trendlines Group. With us today are chairs and CEOs of Trendlines, Steve Rhodes and Todd Dollinger. As travel restrictions due to COVID still prevent management from being in Singapore and meeting with people face-to-face, we decided to initiate this call. It provides an opportunity after publishing our 2020 results to touch base, review the period, and answer any questions that we receive from time to time and today. So, Steve, before we jump into specific questions, can you give us a quick review on the highlights of 2020?
2020, despite the pandemic, was actually a very good year for us and for our portfolio companies. We had a number of very exciting developments, Shira. Obviously, one of the most important developments of the year was the ApiFix exit, which we've talked about a lot. But on top of that, we had a great year for the rest of our portfolio companies. We had 34 portfolio companies raise capital, follow-on capital, which is an all-time record. And I think it bodes extremely well for the future of our portfolio. In fact, 2 of those raises were in excess of $4 million, which also reflects the fact that our portfolio is beginning to mature. And as the companies make progress, they raise more and more capital. In that same vein, we had a number of companies that launched sales last year, and despite the difficulties of selling during the pandemic, they were able to achieve good growth and are looking forward to even better growth this year. And finally, our Ag Fund, our new Singapore-based venture fund, not only completed its first raise, but also made its first 3 investments in some very exciting companies. And so we think we're extremely well poised for a great 2021 and beyond.
Okay, thank you.
If I may, I would just add that Steve noted, of course, that we are agri-food investors. But I think also one of the reasons that last year was so strong for us is because we're life science investors, but focused only on 2 areas. We invest in agri-food and we invest in healthcare. And these are areas that garnered enormous attention last year. It all speaks to our mission of creating and developing companies to improve the human condition. And this mission, I think, fits so well with our times, and our investment areas obviously were very much in line with investor interests this year.
That is definitely true, and we've seen an up on all the metrics in healthcare and an interest in agri-food, food security, etc. The ApiFix sale, though, happened in the midst of the COVID crisis. We were sitting at home, complete lockdown in Israel, and a lot of places in the rest of the world were doing the same. Was the deal affected by the crisis, and in what way?
Well,
Todd?
It's great question. In April, we had 2 major events, actually. One was, of course, our exit from ApiFix that we sold to OrthoPediatrics, a public company traded in the US. And also, not to be ignored, is within days of that exit, which occurred on April 1 last year, we had Johnson & Johnson invest for the second time in our portfolio company, OrthoSpin, another orthopedics investment of ours. That was actually a $5 million investment that Johnson & Johnson made with us. We were the 2 investors led by Johnson & Johnson. And April, as I think of it, was really the height of the confusion over what was happening with COVID. And yet both of these deals closed. Did it impact it? There were constant conversations about what was going to happen, what would happen. We understand, we saw that many major corporations slowed or stopped their investing. But both of these deals not only occurred, but occurred exactly as scheduled, in spite of the difficulty of so many people working from home, of confusion and uncertainty. And I think it speaks to the strength of our portfolio and to those particular companies that those deals happened exactly as scheduled.
Okay, great. Thank you.
Sure, I see that one of our viewers has asked a question about the exit. Since we're
okay.
talking about it, maybe we'll just go ahead and answer the question now. The question is, how much of the OrthoPediatrics shares are we still holding? As you recall, most of the payment of the first round of the exit was in shares. It turns out that we actually sold all of the shares that we were holding. The shares were locked up until October, and we were able to sell the shares in October, November. Actually, we sold them at a much higher price than they were, the price at which they were issued.
Right. It was very interesting what happened when the acquisition of ApiFix by OrthoPediatrics was announced. The analysts thought this was great, and it had a really positive impact on OrthoPediatrics. We saw their share price go up substantially, and that was very much to our profit. We had, I believe we reported, a financial profit on the shares of some $2 million US, just by virtue of the fact that between the time we received the shares and ended our lockup, and then we chose to go into the market carefully and sell the shares, that was an additional $2 million in profit. But I think even more important than that $2 million is that those who are paying close attention to that deal will remember that in the fourth year, there is the opportunity for an earnout. And that earnout is actually carried on the books of OrthoPediatrics, a public company, so you can see what they're carrying it at. And it's very clear, the numbers are there in print, that they expect to make a very substantial earnout payment to us in the fourth year.
Right. Okay.
So we're very excited about that. We're very excited about how the analysts see it. And once again, it just speaks to our mission. Working in scoliosis with ApiFix, this is such a powerful help to these kids who need that surgery and to their families, where we've taken a surgery that could put them in a hospital for a week and give them a year's recovery, and taken it to being in the hospital for 2 days and being fully recovered within weeks. It's really borders on the magical.
They actually just issued a press release, OrthoPediatrics,
Yes.
that is, announcing that they had hit the 500 case milestone, that there have now been 500 cases done with the ApiFix system.
Since they acquired it.
Well, no, not since they acquired it, since the beginning of ApiFix.
Oh, okay, okay.
And the company has now achieved 9 full years of clinical results, and it's very significant.
Thank you for the elaboration on that. Steve, you mentioned that 2 companies got investments of over 4 million. Can you elaborate on the second company? We've already spoken about OrthoSpin. Can you tell us a little bit about Phytoline and the excitement with that company?
Sure. Phytoline is one of our food tech companies. It's a company that has developed great technology for manufacturing completely natural food colors through a fermentation process. From a sustainability perspective, it's amazing, because it means that you can, using a very small environmental footprint, produce food colors that today have to be produced by going out and growing thousands of acres of beets or other vegetables that are
for
only
natural food colors.
For natural food colors. It also means that the food colors themselves don't have the flavoring from the beet. It's a pure color. It's repeatable. There's no issue about quality. And it's really the direction that the food industry is going in many different items, natural items, is the use of fermentation to achieve great ingredients. Phytoline has developed this technology. The company raised $4.6 million, including from some of the leading food tech investors in Israel and in Europe. And they've also entered into pilots with a number of the world's largest food and ingredients companies in order to take the product forward and enter eventually into commercial agreements. So we're very excited about Phytoline.
Okay, thank you very much. Okay, we've spoken about the great things that happened despite 2020 crisis or the extraordinary year that it was. Todd, can you tell us a little bit about the biggest challenges that we had to face anyway?
Right. So I guess everyone's heard about this virus that hit us, this COVID-19 thing. That's not breaking news. It's amazing to think back to the beginning of last year as we started to become aware of this, as we saw this thing happening in China. We heard about it very early because of our offices in China and concerns that were expressed about travel, about what the situation was going to be, how matters would develop in China. Shortly after that, we saw Singapore hit, and then it came to Israel, all within a very short period of time. All the countries reacted differently, and we adjusted both to local conditions as to our general concerns and the corporate direction that we gave. One of our first moves was in very early March, we shut down international travel for all the offices, for all of our staff. As we're accustomed to traveling a lot, not just between our offices, but to work with our strategic partners, that required adaptation. Fortunately, we had just recently completed an in-house review of all of our IT, and we had substantial bandwidth available to us that we came back and then increased. It was also then during March that we started putting people into work from home mode. We generally were ahead of the government in making these decisions, particularly in Israel, but I think also in Singapore. We chose to take the safe route. And because we're an investment company and many of our staff are professionals, they're accustomed to travel, they're accustomed to being able to work from different locations. We went back and made sure everyone that had the equipment they were needed, even including our bookkeepers who began to work from home. They were the only part of our staff that didn't have laptops. They all have laptops. There are scanners. We went into people's homes and increased their bandwidth where that needed to be done. Our goal was to make it as easy and as efficient as possible for our staff to work from home. And that it really worked out well for us. I personally don't believe that we were quite as effective as working from the office, but I think we've come through that extremely well. Israel has now been pretty much fully reopened from a business point of view for, I think it's about 3 weeks. We should also note that Israel has the highest vaccination rate in the world. Looking at yesterday's numbers, if you combine those who have recovered from the virus and those who've been vaccinated over 16 years of age, we're more than 85% of our population is vaccinated or recovered. So we really have amazing numbers in Israel. These percentages will continue to rise, and most of our restrictions are off. We're continuing to wear masks in public spaces, but we're back at the office, and I think we have some improved efficiency. Now, I think everyone wants to know about the portfolio companies. And the portfolio companies, we really recognized the level of uncertainty that everyone was feeling, that we were feeling, the companies were feeling, that our investors were feeling. And we really made a goal out of finding stability. And how do you do that? And one of the things that we did, again, at the corporate level, was that we determined that we were going to continue, as they say, to play our game, to push forward. And we made no staff reductions, and everyone continued to work hard. We renewed that commitment to our staff, and we renewed our commitment to our portfolio companies. During the first months, we had a tremendous amount of time and energy that went into sitting with each of our companies, virtually sitting with each of our companies, to carefully review budgets and to review goals for the year. Where we saw the greatest difficulties were really with the companies that were early into new clinical trials. Patient enrollment became very problematic as hospitals really were not prepared to do non-essential surgeries. So that really was shut down in the first half of last year. And we dealt with that. There were delays, and this did slow some of our companies. Additionally, companies that really required sales calls to be made, we saw some pain from that as well. All in all, speaking in generalities, the companies did extremely well. We began to do physician training and to do training on our agri-food side virtually. Many of our companies produced animations and videos to support their sales efforts and to produce and to as well support clinical trials efforts. Our theme really was finding stability in uncertainty. And I think it's fair to say that we came through that pretty well. Some of our companies experienced some pain. Trendlines in our offices, overall, I think we adapted very well. And now we're, of course, thrilled to see ourselves coming out of that. We see that the elective surgeries that were delayed are very much back in process that began in the third and fourth quarters of last year. So there's the story on impact on COVID.
Okay, thank you. Let's look a little bit, dig a little bit deeper into our financial results and some of the results of the company that we posted on 2020. Steve, you commented in the press release on the financial results that the exit of our portfolio company, ApiFix, resulted in positive cash flow from exit proceeds, which was very good news for Trendlines in 2020 and in the coming 3 years. Can you explain and elaborate on that? What does it do for us as a company? How does it push us forward?
Well, as Todd alluded to previously, the ApiFix exit brought not only cash in 2020, but there are also 4 future payments that are expected. 3 are guaranteed payments. The first one is expected most likely in the second half of 2021, and that relates to the completion of 150 clinical cases. And then there are additional milestone payments at the end of the 3rd and 4th years from the signing of the agreement. In addition, there's also the earnout, which, as Todd mentioned, is actually now projected to be higher than what we expected. The earnout is based on a calculation of the sales of the device by OrthoPediatrics in the 4th year. And when we look at OrthoPediatrics audited financial statements, they actually are telling the market what they expect to pay as the earnout. And they report paying over $42 million, expecting to pay over $42 million in total as the earnout. Our share is about 20% of that. So that's very, very good news for us in terms of future cash flows and cash that will be generated from that exit over time.
Okay, so I'm going to jump again because we have a question also from the audience on that. So despite a successful exit in 2020, no dividends were declared for the year. Can the group give us some clarifications on dividend policies and how those are weighed up?
Yeah, it's always a good question. It's always a fair question. Dividend policy is a frequent discussion of our board of directors. And it's a challenge for us to find the right balance on that decision, candidly, because of course we like the idea of giving dividends, and yet we have to recognize the fact that we are an investment company. And as an investment company, we have the ability to make good use of that capital. As everyone knows, we are early stage investors. Early stage investment makes up an important portion of the investments that we make. And the early stage investing means an opportunity for us to invest at low valuations. We like to take advantage of that, and we like to take advantage of the capital at hand for that. But it's a balance, and it's a difficult decision to take and a source of constant conversation.
It's interesting. I remember years ago in finance courses that I took in university being taught that paying dividends is a bad idea. According to financial theory, if a company knows how to take capital and invest it well and to create value, it should do that. And it should hold the capital and not pay out dividends. In fact, we have a number of shareholders, important shareholders who are experienced investors who have discouraged us from paying dividends because they say you should be taking the capital and reinvesting it into your portfolio and building more value. And we see that actually as our companies progress, their value is going up, and we actually expect bigger, higher, larger exits in the future as the companies are more mature when we exit them. So we expect to generate bigger exits. On the other hand, we understand that for many investors, they view dividends as very important and meeting with cash as being very important. And so as Todd said, it's a discussion we have very, very frequently. And we continue to have it. Todd said we do it at the board level. I think we probably, even at the management level, are talking about it much more often than that.
Right.
And it's something that we will continue to discuss because it is one of the top of mind issues for us, particularly as we start to see the cash situation. Sure, you mentioned that our cash position is improved.
Right.
Obviously, one of the decision factors when you decide whether to pay a dividend or not is, do you have enough cash to support your ongoing operations? We can't pay out dividends if we don't have sufficient cash for operations.
You can't do that anyway, according to
But I wouldn't.
the law, right?
That's true. But the law aside, the responsible thing as managers is to make sure that the company has the cash to support its operations, to support its investments and its portfolio. But we also do want to pay dividends, and so we continue to talk about it on a regular basis.
Okay, thank you. So that brings me to another question that we have from our audience, that in fact, the total portfolio value decreased in 2020 in a sort of absolute way, in the way that we show our graph. Can you explain why this happened? What goes into how we present our portfolio value to the public?
Portfolio value went down in total for two main reasons last year. One was, of course, the Epifix exit. Epifix had value, and by moving it off of our books, the value of the portfolio went down by the amount of that valuation. In a sense, you could imagine that we just moved that valuation from the portfolio over to cash. So that was a big part of the decline. A second part of the decline, unfortunately, was from the valuation of our asset Stematics, that the performance of the Stematics royalty has been disappointing so far. We continue to believe that it has great value and that it should be a great success in the future, but we felt it prudent to write down the valuation of Stematics in light of the fact that it has not performed so far as expected. The good news is that actually net of Epifix and Stematics, the overall valuation of the portfolio went up again. So if you're looking at the other 56 companies in the portfolio, actually, and as I'll explain in a minute, the other 44 valued companies in the portfolio, the valuation went up. And I say that because there are 12 companies in the portfolio that aren't given any valuation whatsoever. They're consolidated into our financial statements, and so they're not reflected in the overall portfolio value. I think on balance, it was a strong year for the portfolio. The fact that it went down nominally is disappointing, but in the long term, I think we'll see it continue to go up.
It's a good opportunity to remind our listeners that the valuations are not done by management. The valuations are all done by an outside valuation company, are done on a regular basis. And I think there's value in pointing out that those valuations conducted professionally are very different than the valuations at which we experience exits. Epifix was another good example of that. The valuation at which we carry a company the day before an exit occurs and the occurrence of the exit, we're talking about, I think it's approximately a 3-time difference. Is that right, Steve?
3.5.
Yeah.
3.5-time difference. So we carry these companies on our books on the basis of the outside valuations that are done. And then we see the reality of what occurs at exit, which on average is 3.5 times higher.
It's interesting too to note. I remember since we went public 5.5 years ago, we have always said that even though the portfolio value has gone up every year since we started, we expect that someday, one of these years, it will go down because we're taking risk. We have companies that the values go up, they go down, and we've always said that our earnings are going to be lumpy because of the valuations of the portfolio. I'm actually surprised that it took 13 years to see the first decline in value, although at the end of the day, I'm not overly upset about it, since it really is accountable to one, a write down of schematics, and to a big exit, an Apifix.
Right. Also, there are some investment companies, though, that do publish individual portfolio company values, and we're often asked why we don't do this, so that our shareholders can see exactly at what stage each company is in terms of outside valuation. Why do we not publish this?
Well, it's a family of private companies that we invest in, and we have not only our own concerns, which I'll address in a second, but we're dealing with individuals who have a preference that these numbers not be released. For our own sake, it's easy to see, and here we have to agree with our partners in these private companies, that for negotiation purposes, since we're constantly raising money for portfolio companies, as we discussed 34 companies we raised for last year, we're not keen in exposing our internal very low valuations. It just becomes unnecessary noise in a negotiation to have someone point to us, you're carrying it at this value, but you're saying that the value is X for the purpose of my investing, which is a multiple often of what we carry it at. So with as much noise as occurs in any negotiation, if we can avoid that particular piece of noise, we're happy to do it where we can.
Todd noted a few minutes ago that on average, the exit value of at exit is 3.5 times the carrying value on our books. That's a great jump. And the last thing we would want is for a potential buyer to look at Apifix or any other company and say, but you're only carrying it at a $5 million value. So I'll give you 10 million and double I'll give you twice what it's worth. We're getting 3.5 times on average, and in some cases much more. So it really is it's sensitive information that we would rather not disclose if we don't have to. Obviously, we understand the interest from the market to understand better the valuations, which is why we do publish the list of our 10 most valuable companies, and we aggregate their value to give an idea of where the value is concentrated.
Yeah. And as Steve points out, we have this list of 10 most valuable companies. We really encourage people to look at that for a few reasons. One is it represents a very important percentage of our total value. And for the investor who's trying to understand trend lines, these are good companies to be looking at, to understand what we're doing, where we're at, for you to judge, are we making proper investment decisions? So we think it a good and important list for everyone to review.
Okay, this brings me to the next question about companies that are written off. Why do we not disclose the names and the values of the companies that are written off? We usually just mention that 1 or 2 or 3 companies were written off in any particular period. But often we're asked, which companies were they and what was their value?
Well, the first comment I want to make is that when you take a look at companies that we write off, we tend to write off companies when they're quite young and are carrying a low value. And this really speaks to our whole investment modality. We are early stage investors, very often creating companies. And with that, it means that we're coming in at a low valuation. And when we do write-offs, we try and do them early. Now, let's also draw a line. And that's, here we're really focusing on, for the purpose of this conversation, on these very early stage investments that we make. We also invest in companies that are more mature. The ratio of the write-downs is much higher on the early stage, high-risk investments. We're investing in companies that are ideas, that are concepts, that may have been brought to us with a prototype, or we may have invented and developed in-house. So we have this wonderful aspect of our investment model, which says invest early, invest often, and take the write-downs early, and then move on.
You know, there's another reason that we don't announce the names, and that's that in many cases, we will write off a company that's still operating.
Right. What does that mean?
It means that the company is still in business, but either our share has become very small through dilutions, because of low valuation rounds and high investments, or we've just simply lost confidence in the company and we no longer believe in it. And so we decide to write it off, but we don't want to harm those companies. We have no interest in hurting an operating company, and we wish them success. In fact, one of our exits was from a company that we had written off. It could be very damaging to a company to us to announce that it's been written off if they're still operating.
Right.
And so we're very careful not to do that.
And to add to Steve's point, point well taken, is that of course we write checks. We are investors who write checks, put that money into the companies. But an important part of the way that we invest is that we're deeply involved in our portfolio companies. We are very hands-on investors. And that's part of the commitment that we make. It's a very important part of what we do. Anyone who wants to invest in very early stage, we would always recommend to them, don't just look at the check that you're going to write, but take a look at your opportunity for involvement to help guide, to help bring your experience to that company. Well, for us, that's an important part of what we do. When we write off a company, we not only are not, of course, investing in the company again, or we don't plan to at that time, but typically we're resigning from that company's board of directors. We're discontinuing our activities with that company. So that's a very important part of what we do. It allows us to reallocate our efforts to companies that we believe reasonably can be more successful. Of course, Steve brings up the interesting case of a company that we wrote off, and then we re-engaged with later when we saw some changes, and we had an exit with that company.
Okay, thank you. I think that adequately covers our portfolio value and write-offs. We've had two questions here from the audience that talk about the company's valuation in the market. Our share price has been under pressure in 2020. It also hasn't taken off and regained where we started trading when we first listed on the SGX, and that the company seems, and as we say it ourselves, deeply undervalued. One of the questions is, do we think of taking on a strategic partner? How do we see our undervalued share being able to recover itself? How do we convince the market that our share price is in fact undervalued and should be valued at a much higher level?
It's a great question, and it's a source of continuing frustration for us as well as for our shareholders, quite obviously. When we look at the market overall, as was pointed out, it did quite well in 2020. We also know that our peer group in London did extraordinarily well. Companies that do substantially the same thing that we do, but are traded on the London exchange, went up dramatically in 2020, along with the rest of the market. Actually, they outperformed the market. So it's an issue for us. It's a source of great frustration. I think that part of it relates to the previous question about dividends. I'm certain that there are some shareholders who want to see a meeting of cash. I think there's also a question about, in the past, there's been a concern about our cash position, that concern should be reduced today, given the strong cash position that we had at the end of the year, given the guaranteed payments that we have coming in the future from the Epifix exit. And so I think that should be reduced. I also think that as we generate additional exits, we've now had 4 exits, excuse me, since the IPO in 2015. 3 of those exits were, I would say, small in terms of the cash generated for Trendlines. The Epifix exit is generating a significant amount of cash for us. And as I mentioned previously, I think that the future exits will continue to see the values going up. And I think that those things together should impact on the share price. Of course, I don't buy or sell our shares, so I can't comment on what is really going to move the market. But I think if we continue to perform and create value, we'll see it go up. And I do believe that our portfolio today is in a much stronger position than it's ever been before.
Okay, so one of the other one of the other questions is that are there we've seen a lot of companies get funding, follow-on funding, and improve their valuations. Are there any other big exits or possible exits that we see on the horizon? Is this something that we can talk about?
No, to part of it, yes to the other part.
Okay.
We're actually very optimistic about where we're headed. We have an increasingly maturing portfolio. We see, as I mentioned very early in this conversation, that we're absolutely investing in right areas as life science investors in agri-food and in the healthcare industries. And also on the social side of this, we can't forget, it's not just that we have a mission, but we're exercising that mission. And it fits so well today with investors who are more interested, increasingly interested in social issues. And we're very proud of that. We've been there since the beginning. We had a mission since the beginning of creating and developing companies to improve the human condition. We continue to allow that mission to inform us on all of the decisions that we make. We fully expect to continue to be successful in the development of portfolio companies. I think it's a reasonable expectation, and Steve touched on an angle of this, that we will see values of exits increase in value. And because we have a stronger balance sheet now, we will look longer term where we deem it appropriate. Interestingly, we're often compared to venture capital funds. And of course, we have a couple of venture capital funds, but at our core, we're an investment company. And one of the privileges that we have by virtue of being an investment company, rather than a venture capital firm, is that we can stay with a company as long as we deem it appropriate to do so. Unfortunately, that means we'll carry it on our books, undervalued, experience would suggest. But we hope by talking about our companies, by answering questions from our shareholders and potential investors, that they'll better understand the value of the individual portfolio companies and how that should reflect into our stock value.
Okay, so I have two more questions. We've been taking a few from the audience during the time. But another thing that's on the in front of investors at the moment is the proposed Trendlines 2021 MBO plan and exit bonus. Is this in line with industry and peers compensation? Why should shareholders approve this compensation plan when no dividends have been paid out?
Well, as managers, Steve and I have the responsibility of making sure that we surround ourselves with other managers who are competent, who are dedicated, who can drive Trendlines towards success. And that's a complicated issue at Trendlines because it's not just about dealing with our corporate issues, our strategy, our operations, but it's also digging down into every single portfolio company. And to do that, we must surround ourselves with the right people, people who can take responsibility today for guiding our portfolio companies and can take increasing responsibility within the Trendlines group. So it's critical we have the right people. To have the right people, I think it's clear we need to provide the right compensation program and incentives. Now, the program that we have today was not only created with professionals who guided us on the creation of the program, it was benchmarked against similar companies. And in the most recent review, and here we did a full review after 3 years of having the program in place, we dug in on everything. And we determined that the program components made sense, they fit the market, and we believe that they will continue to sufficiently incentivize our staff to stick with us, to grow with us, and eventually to follow us in the years to come.
Maybe just a technical clarification, Cheryl. The proposal that we're asking the shareholders to vote on is not a compensation plan. It's not a bonus plan. It's a policy. The policy is required under Israeli regulations to set the upper limits of what the board of directors can do for compensation for senior management. The actual bonus plan that we have is a subset of that, and it's always been less than what you see in the policy that's being discussed and approved. So we have to emphasize that's not what we're doing. It's the upper limit
of what
in order to provide our board of directors with flexibility and also with guidelines about what the upper limits are. But we've never reached that upper limit. The other thing I'll just mention is that everyone knows Israel is the startup nation. The tech sector in Israel is very, very hot. Todd mentioned that we have to attract and maintain the best management. And it should be clear to everyone that our managers have alternatives. They can go out and find jobs in the tech sector, which is very, very hot. They're constantly receiving phone calls from headhunters trying to poach them. And we need to maintain the staff and the stability of our staff. I think it's an important asset.
Right, in order to move ourselves forward.
Exactly.
Right. Okay. So if we talk about moving ourselves forward, what can you tell us a little bit about not the past, but 2021 goals? What are our goals? What are we looking forward to?
Well, I think that one of the important goals for 2021 is to continue the trend we saw in 2020 of lots of companies succeeding in raising follow-on capital and bigger raises. In fact, I mentioned before that last year we had 2 companies that raised over $4 million. That was a record. This year, I wouldn't be surprised if we had between 5 and 10 companies raise over $4 million. We're actually now in the process, I think, of closing 2 or 3 investment rounds in excess of $5 million. And the size, I emphasize the size of those raises because it reflects the maturity of the companies. And this is also something that reflects on the size of the exits ultimately. In the past, we were under a lot of pressure to produce exits. We sold companies early. The exits were relatively small. But because we have the ability to stay with companies longer and we're seeing the companies raise greater amounts of money at much higher valuations, I expect that in the long run, we will see lots of big exits at very high valuations. So I'm really looking forward to, if not having more companies raise it, raising more money this year. Last year, our companies raised $42 million this year, and I'd like to see us break that record this year.
I think one of the records we'll certainly break this year is for largest raises. Steve mentioned that we see companies raising more money, which is indicative of the interest that other investors have in these companies. It also is indicative of the maturing portfolio once again. But I've no doubt that we'll see larger raises than we've ever seen before in our portfolio companies. And this isn't just about seeing them meet up with cash. It means it's going to allow them to achieve more. It's going to, in most cases, we fully expect, it's going to increase their value. And then this rolls on to us for increasing our value and bring us closer to more larger exits.
Okay, great. We have a question here that talks about opportunities that we look at, in that there are interesting companies in cellular reprogramming, in anti-aging, in longevity, in different facets of healthcare and agri-food that have become hot topics. What are the kinds of opportunities that we're looking at? In what areas, sectors, subsectors are we looking at?
I'll touch on some of the things we're doing in healthcare and leave Steve to comment on some of the agri-food issues. In healthcare, our point of view has always been that within this one restricted area of healthcare to look at all opportunities. And we continue to do this. That said, we've had substantial success in orthopedics and spine. These will continue to be areas of investment for us. We've developed wonderful relationships with major companies around the world in these fields, And I think we're recognized as early stage investors in an area that's considered not so easy to invest in. We're very pleased with our achievements. Of course, we had the ApiFix exit last year. We talked about Johnson & Johnson having made a second investment with us in OrthoSpin this year. And take a look at our website. You can sort the portfolio by sectors. You can look at orthopedics and spine. And when you do that, also take a look at urology. Urology, which crosses also into women's health, or is now it's being called more frequently femtech, is an area of great interest to us as well. When we look at investments, always the first focus is market. What is the unmet market need? What is the size of that need? And we're also looking, before we make an investment, as to where's the exit opportunity? Who are potential acquirers for this company? Is it a company that we could take public? And of course, if we do that, sell the company or take it public, what valuation, looking out years in advance, what valuation can we expect? What return on our investment? And of course, we're looking as well at the total capital that it requires to get us to those goals. We, of course, are always looking at movement in science and technology. We look at new materials, but first and foremost, we focus on the market. And we look to guidance as well from our major strategic partners. Typically, before we make an investment, we've gone out and met the market. We've spoken to major companies like B. Brown or Boston Scientific or Johnson & Johnson about their thoughts on these areas of investment. So we'll continue to look ahead, and we'll continue to focus where appropriate in areas like orthopedics and spine or in urology, but we'll look very broadly throughout healthcare for investment opportunities, whether it be digital health, big data, artificial intelligence, or surgical tools.
Steve, a little bit on the agri-food.
Yeah, it's interesting. The pandemic in 2020 really brought into focus issues that had already been trending in the agri-food sector prior to that. And what I'm referring to really is the whole issue of sustainability. Agriculture and food production are estimated to produce up to 50% of greenhouse gas emissions, which is incredible. On the one hand, we have a growing population. We need to feed that population. We have fewer and fewer resources with which to do it. And at the same time, we have to do it in a way that's sustainable and that doesn't destroy our planet. So it's a major issue for us. Fortunately, the portfolio that we have of some 20 agri-food companies, all of them in some way contribute to the improved sustainability of the agri-food process or ecosystem. And in fact, we're now launching a process to help each of our companies, our portfolio companies, evaluate their impact on the environment so that they can potentially even monetize that. We know that there are investors who are increasingly looking for that as a factor that they consider when they make an investment decision. So we're looking if we can monetize it either through valuation from investors or through business models. There are companies that are actually able to monetize reductions in carbon emissions, for example, as a result of their technologies. So I would certainly say that one of the big trends in agri-food that we're looking at and that it affects how we consider making new investments as well as how we work with our existing portfolio is the whole issue of sustainability and impact on the environment. Another issue that came up very strongly during 2020 was the whole issue of food security and concerns about supply chain. There were many countries that saw their food supply threatened as a result of the pandemic. There were predictions of coming global famines and interruptions of the food supply. And many of our companies contribute dramatically to improving the supply chain. We're actually now also looking more and more increasingly at supply chain as an area to invest in, since we understand the importance of rationalizing the supply chain and making it more efficient to increase food security.
Okay. I'd like to ask the last question, seeing as it's also something that came up in the news recently. The other Israeli company, Serene Technologies, that is traded on the Singapore Stock Exchange, recently announced that it was seeking a dual listing on the Tel Aviv Stock Exchange. Is Trendlines thinking of going in the same direction based on the agreement between the SGX and the TASE a while ago for the opportunity of dual listings?
Well, let me start by a general comment, and I'm sure Steve will want to follow up. Of course, it's interesting to see what Serene has done. We've been engaged in conversations with the SGX for years. We've participated in many meetings with them and discussions about their interest in Tel Aviv. We are very simply entrepreneurs at Trendlines. This is at the core of all that we do. One of our opportunities to invent is always to look for new business models. You see that in our work with Trendlines Labs that we're not going to have a chance to talk about today. But we will always look at opportunities. We will always look at opportunities to strengthen Trendlines. We have done rights offerings. We've done private placements. Obviously, we IPO'd in Singapore, and later we listed our ADR in the States. Those things that we believe can profit our shareholders and strengthen our company will always be of interest to us, and we'll always be involved in conversations about how to strengthen the company, how to profit our shareholders.
I don't have a lot to add to that, except to say that we are very committed to our listing in Singapore.
So it doesn't mean that you would delist from Singapore?
No, we have no plans to delist from Singapore. It's something that we're very committed to. We're very disappointed with the trading, as we discussed previously, but we think that at least part of that we have to bear responsibility for, if not all of it, and prove to the market that this is a great asset that they should want to own and buy. As Todd said, we're always looking at opportunities. We have an international network. We talk to bankers all the time. We talk to investors all the time, and people throw out ideas, and there's always the flavor of the week. The last year, SPACs have been very popular in some markets. Right. So everyone comes and says to us, "Why don't you do a SPAC?" It's just like, do this, do that. At the end of the day, our focus, although the markets are important for us, our focus is on running the company in the best way possible to create value for our shareholders, and that's what we're doing.
We're very proud of the fact that some of the biggest companies, not just in our industries, but in the world, invest alongside us. Bayer Corporation, B. Brown, Johnson & Johnson, Boston Scientific. These are the leaders in our industries, the leaders in the world. We're very proud that they evaluate our companies and they invest with us. To those who, like us, look at our share price with a sense of disappointment, I would encourage everyone to look beyond, look inside the portfolio, make your judgments about those companies, or call us. We're always happy to talk to folks about what we're doing. And in addition to looking at companies that we've been invested in and continue to support for years, look at where we make our new investments. It shows you our direction. It shows you what we believe is important. And it allows you to judge us as we judge our investment opportunities.
Okay, thank you. We've kind of got to almost an hour, which we've set for the call. So I just want to thank everyone for joining us today and take this opportunity to wish everyone happy Passover, Easter, Ramadan, whichever, spring, all of that together, and hope that we will be able to meet with people in person again in Singapore soon, at some later stage of this year, hopefully. To remind everyone that a recording of the call will be made available on the investor section of our website. and that we welcome ongoing, as Todd said, ongoing open conversation and communications with people, shareholders and potential investors, analysts, journalists, and invite you to send us any questions that were not directly covered today or we didn't have time for, and we will happily answer them.
Well, thanks everyone for joining us, and Shira, thank you very much.
Thank you, Shira. Thank you to
Thank
everyone.
you all. Bye.
Bye-bye.
Thanks, folks.